Hello and welcome back to another summer school class brought to you by eToro. I am Sam North, the trading school lead, and today we will be answering the question, how should I choose what to invest in? I guess before you can answer that question, we should probably go what exactly you can invest in. On eToro, for example, there are many different asset classes that people can choose from. People can invest in stocks, crypto, indices, ETFs, commodities, and currencies. Now let's review these asset classes and find out a little bit more about them. Stocks are shares of ownership in a company. Each share has a value based on the company's total worth. The price of a stock is influenced by supply and demand factors in the market and other variables such as economic or political events. This could be news impacting the company specifically or occurring in the broader industry. Our next video is on how to pick a stock, but some examples which I'm sure many of you will know are Apple, Amazon, Microsoft, Tesla, Rolls-Royce, and BMW. Crypto assets are cryptographically secured digital representations of value or contractual rights that use some type of distributed ledger technology and can be transferred, stored, or traded electronically. Two assets that I'm sure you are all familiar with within the crypto world are Bitcoin and Ethereum. Indices are stock indexes that measure the performance of a particular group of stocks over time. An index is basically a number which reflects the accumulated changes of each stock within a certain group of stocks, which are selected to represent a portion of the overall market. Some common examples are the S&P 500, which we've already talked about loads during these classes, the FTSE 100 and the Nikkei 225. The S&P 500 is the top 500 companies in the US, the FTSE 100 is the top 100 in the UK, and the Nikkei 225, the top 225 in Japan. An ETF or exchange traded fund is a type of investment fund that aims to track the performance of a specific stock market, index, or asset. ETFs are traded on stock exchanges. This means they can be bought and sold just like individual stocks. ETFs are available for virtually every asset class, including stocks, bonds, real estate, and commodities. A commodity is a basic good or raw material that is used to produce more complex goods. You can think of commodities as the building blocks of the global economy. They're used to create products that we rely on every day. Examples of commodities include oil, gold, copper and sugar, silver, platinum. Commodities have been traded for thousands of years. In the past, they were traded physically. Today, however, commodity trading takes place on exchanges around the world, such as the London Metal Exchange, the LME, and the Chicago Mercantile Exchange, the CME. Currency trading is the process of buying and selling currencies such as the US dollar, the euro, and the British pound. Often called forex exchange or forex trading, it involves purchasing one currency while simultaneously selling the other, with the aim of generating profits from currency movements. In the past, currency trading was mainly carried out by banks, institutional investors, and hedge funds. However, thanks to the advances in technology, literally anyone can trade currencies today. Okay. So now we have the definitions of these asset classes covered. Let's quickly discuss reasons why someone would invest in each one. Someone may believe that a certain company will perform well, so they want to invest in them and buy shares. For example, through their analysis, they might think Apple will continue to grow and grow as a company. For crypto, someone may think Ethereum will continue to become more institutionally adopted and have more and more use cases, and therefore want to invest in it now. For commodities, it might be that someone thinks oil price will continue to rise due to supply and demand, and therefore invests in it accordingly. For indices, someone might believe in a certain area of the world and that it will do well in the future, and therefore buys an index composed of companies from that country. For ETFs, someone might want exposure to a certain area in the market like bonds or real estate. And for currencies, someone might want to invest in the dollar, for example, as they believe with rising interest rates, it will continue to strengthen. These are just a few examples. Of course, there are many more that we will discuss as we continue with these classes. Next up for us to answer is the question, what assets are risky and how risky do I want to be? As we have said before, the riskier assets include emerging market currencies, crypto assets, stocks and equity markets, the more volatile nature of these assets will attract investors who potentially want to make bigger returns. But of course, remember it can work both ways. With more risk comes more reward and vice versa. Less risky assets include government bonds from developed countries like the US, or currencies like the US dollar, which is widely considered to be the reserve currency of the world. Gold is also considered to be a safe haven asset sometimes, as well as the yen and the Swiss franc, for example. In the last two videos, we have talked about the different type of portfolios and the returns that more and less risky portfolios can generate. Now we have an understanding of what assets are more and less risky. Hopefully you can now see what assets you would like to focus on. If I was someone looking for larger returns, my focus would be on stocks and crypto, for example. If I was someone who wanted less risk, my focus might be more on government bonds or other safe haven investments. Remember to find your why. How risky do you want to be at this stage? What are your goals? What would a similar portfolio look like based on those goals? One thing that could be so useful in any investment portfolio is having diversification. Spreading your risk across different assets, sectors, geographies, industries, and so on. You may have heard of the saying, don't put all your eggs in one basket. Well, with investing, that is very useful to understand. Don't put all your money into one investment. Reason being, by investing in multiple assets, you reduce portfolio risk. By investing in different asset classes, you can reduce your portfolio's volatility, and this may avoid making rash decisions based on market swings. Each asset usually performs differently in the short, medium, and longer term. So investing in multiple assets can encourage you to make longer term investments. It may also reduce the number of times that the portfolio needs to be monitored. It also reduces the overall impact of market volatility, which can provide stability in times of uncertainty and bring peace of mind to the investor. We just mentioned there that some assets can perform differently in the short, medium, or longer term, and that can certainly be said for stocks in particular too. Stocks can be categorized by sectors, so let's review those now. The Global Industry Classification Standard categorizes stocks into 11 sectors. Energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and real estate. Each of these sectors can typically perform better or worse during the different parts of the economic cycle. For example, if we are heading into a recession where people are generally not spending as much, then investing in consumer discretionary items like luxury fashion brands would be quite unwise. But if the economy is in a growth phase and people are spending money and the economy is booming, investing in these more discretionary items and companies that associate with that, it would make more sense. In general, the economic cycle can be split into 4 areas. The peak phase of the cycle is where the economy generates growth. The recession phase is where the stock prices are likely to fall, which then leads to the recovery phase, where stocks start to gain momentum, which then leads to the expansion phase, where economic growth expectations rise. Trying to understand what type of phase we are in can be beneficial for the investor who is looking to time the market. For example, if we are in the recovery phase, investors may look to start investing again ahead of the expansion and peak cycle phases. Investors can also consider seasonality when it comes to investing. Have you heard of the saying, sell in May, go away, or buy when it snows, sell when it goes? Fundamental analysis can tell us what to buy and sell. Technical analysis can tell us when to buy and sell, but seasonality tells us what and when to buy and sell. A number of yearly recurrent events produce seasonality. An analyst who studies seasonality must determine whether annual events are likely to occur again before a period of seasonal strength. The seasonality analyst will not advise a seasonal trade if annual recurrent events are less likely to occur. The end of October to the beginning of May has historically been a time of seasonal strength for the S&P 500. The buy when it snows, sell when it goes tactic is the name given to this. When the first snow falls, this often occurs around the end of October. Equity markets historically begin to go higher. Then we get to April, when the rest of the snow has melted, equity markets often hit their seasonal peak. Equity markets follow a similar seasonal pattern all around the world. If you are someone who wants to better time the market, this information could be quite useful. But remember what we say all the time: past performance is not indicative of future results. In summary, we reviewed the different types of assets, discuss which are more and less risky, and why diversification is important. We talked about seasonality and the economic cycle and how that could influence our decision as investors. Ultimately, what you invest in is up to you and can depend on a variety of variables: how much risk you want to take, your time horizon, where you are in your investing journey, and so on. Our next video is going to be on how to pick a stock. Until next time, see you later.